Based on our field observation, retail and small-scale foreign exchange transactions in Malaysia are largely conducted through licensed money changers rather than in branch bank counters. This reflects a structural shift where money changers function as the primary access point for spot foreign currency exchange. In this setting, foreign exchange risk is not only driven by a long-term currency movement but by short-term volatility and timing mismatches between when transactions are needed and when exchange rates are most favorable. Our fieldwork also shows that exchange rates and buy-sell spreads vary across currencies are frequently updated, exposing users to pricing uncertainty, especially when transactions are repeated or time-sensitive. As a result, businesses and individuals who rely heavily on spot conversion face the risk of margin erosion and unexpected cost increases if exchange rate movements are not actively considered. This highlights the need for practical context-specific approaches to managing currency risk in market where money changers play a central role in foreign exchange transactions. Given this reality, the key question becomes, what should users do when money changers are the primary channels for foreign currency exchange, especially in Kuching International Airport? So, based on our research, our first recommendation is that users should match the purpose of their transaction with how they use money changers. Based on the literature and consistent with our field observation, licensed money changers are most suitable for immediate small to medium-sized foreign currency transaction, where flexibility and competitive spot rate are most important. This aligns with Koji et al. 2019, who highlight that for short-term and transactional needs, money changers provide efficiency and accessibility that formal banking channels may not offer. However, relying heavily on repeated spot conversion introduces timing risk. This leads to our second point. Users should actively manage timing risk, not just focus on getting the best price at a single point in time. Most foreign exchange losses occur not because of bad rates but because of poor timing. Even small exchange rate movements can accumulate into meaningful losses when transactions are frequent. As highlighted by Kohler and Stockhammer 2023, exchange rate fluctuations can have compounding effect, particularly when users repeatedly convert currencies without considering short-term movements. Therefore, spreading conversions over time and monitoring short-term trends can help reduce exposure to adverse exchange rate movements. In short, effective currency risk management in this context is not about predicting the market but about using money changers strategically and deliberately.
Money changers should continuously adjust their buying and selling rate based on real-time market movement rather than relying on fixed margins. Our field observation shows that exchange rates are frequently updated using digital pricing systems reflecting current market conditions. We also found that buy-sell spread differ across currencies. For example, currencies like the Indonesian rupiah and Saudi riyal have narrower spread due to higher liquidity and lower risk, while currencies such as the Japanese yen and Thai baht have wider spread to compensate for higher volatility and lower liquidity. According to Evans and Lyons 2002, exchange rate responds strongly to order flows and short-term market demand, supporting the need for dynamic pricing strategies. Dynamic pricing is important because it helps money changers to protect themselves from sudden losses when currency depreciates sharply. At the same time, it allows them to remain competitive while maintaining a profitability in a fast-moving market. In addition, money changers should monitor inflation and interest rate differentials to anticipate medium-term currency movement. This is supported by the International Fisher Effect, which explain how currencies such as the Japanese yen and Indonesian rupiah tend to show expected appreciation or depreciation pattern based on inflation and interest rate trend. Johnson et al. 2010 further confirmed that inflation and nominal interest rate influence exchange rate, both the short and long run. By anticipating depreciation, money changer can reduce the exposure to risk currencies and adjust spread early, helping to minimize potential losses. From a business perspective, these findings have important implications for money changer. First, dynamic pricings play a crucial role in protecting profit margins. Since money changer hold foreign currency as inventories, sudden exchange rate movement can lead to immediate losses. As observed in our fieldwork, currencies such as the Japanese yen and Thai baht show higher volatility. By widening buy-sell spread during unstable period, money changer can transfer part of the exchange rate risk into pricings, resulting in more stable daily earning and lower exposure to depreciating currencies. Second, monitoring inflation and interest rate trends allow money changer to manage risks proactively rather than reactively. Based on the international Fisher effect, currency with higher inflation such as Japanese yen and Indonesian rupiah compared to Malaysian ringgit are expected to depreciate over time. Anticipating those movements enable money changer to adjust spread early and reduce potential valuation losses. Finally, money changer also have a responsibility to guide customer on appropriate usage. While money changer are ideal for immediate, small to medium-sized transaction, repeated spot conversation expose user to timing risks. By educating customer, money changer can build trust, improve customer relationship, and strengthen their professionally and ethical standing.
So in summary, foreign exchange risk in Kuching, Sarawak, Malaysia is largely managed through money changers at the transaction level. Our findings show that effective risk management depends not on predicting currency movements, but on informed usage, timing disciplines, and proactive pricing strategies. When both users and money changers act deliberately rather than reactively, exposure is reduced, profitability is protected, and market stability is strengthened.